Hi, I'm Eric Burkholder here with Jordan Bradford, Burkholder Wealth Management, and we're coming today with another video. The topic today is the election.
Yeah.
So a big one. We're already getting questions, certainly to get more questions as the year goes on. So we thought we would do a video a little earlier on in the
hmm
year so people could watch it and be available throughout the year. But the big question is, what should we do with our investments with an election coming?
Yeah.
And then the second follow up is it depend who wins what we should
Right.
do. So um, what we always stress here is data and
hmm
information. And so, Jordan, do we have any information that can be useful about markets and elections?
Yes. Fortunately, we do. Otherwise, we probably wouldn't be doing a video like this if we didn't have any good information to share. And in this case, we've got some really great info. So I'm going to kind of kick us off with some numbers just to give us some context as to what's going on in election years from a market perspective. First and foremost, if we look at just the S&P 500 as a whole, and you go back all the way back down to, I believe it's 1928, the average annualized return on the S&P 500 is 10.1%. So, that's pretty good return, right?
Mm-hmm.
The question is that in an election year, a presidential election year specifically, which happens every 4 years here in the United States, what happens in those years? Because obviously we know there's some additional volatility. We know that there are some extra things going on in our country that we certainly have split opinions on across the nation. So in election years, presidential election years specifically, the average annualized return in those years is 11.57%. So about 1.5% better in presidential election years on a return average than what you get in just a average year. If you just were to pick a year out, by random chance, your average return is actually going to be a little higher if you just select from those election years. What's even more interesting is the year after elections as well, which is a big deal because we know elections occur in November. So it's right at the end of the year. So, some folks might say, well, that doesn't necessarily take into account, the actual investor sentiment as to who wins, right? Well, in the year after a presidential election, the S&P 500 has actually returned about 10.67%. So a little less than those election year returns, but still about 0.5% higher than the historical return for the S&P 500. So that may not seem like a lot, but when you think about a presidential election year occurring every 4 years, and we have data going back nearly 100 years at this point, if you added 25 years of 0.5% performance to your portfolio, that's going to compound to something pretty substantial. So we certainly wouldn't want you to miss out on that because you were concerned or thinking that maybe that's not the best time to be invested. That of course is the S&P 500 numbers, though. The international numbers are even a little more striking, I would say. So if we look at the developed markets internationally, the average annualized return is about 7.98%, almost 8% average. In election years, for U.S. presidential elections now, international is actually a little lower. So it's about 6.14 in election years. But where it really gets kind of interesting is the year after. And in the year after a U.S. presidential election, the international market has actually averaged about 14.22%. Wow. So almost double their normal average, and that's the year following an election. If we look at emerging markets as well, the other portion of the international market that we invest in, average returns about 8.18, election year returns about 5.44. But get this, the year after a presidential election in the United States, emerging markets have historically returned about 30.3%.
Yeah, that is surprising even to me, who
Yeah.
we do this daily for a living. Yeah, and what my takeaway from all that data you gave us was, and you did touch on this, it can be very dangerous to try to time the market. And in
Yes.
general, we know on average markets are positive.
Mm-hmm.
And I think another takeaway there is Election years are no different. We would
Right.
expect on average them to be positive. Some differences there between election year and post, but still
Mhm.
within the ballpark of some normal expectations of market returns,
Yeah.
right? And I think that speaks to there are so many factors affecting the market.
Hmm.
Despite what the politicians want you to think, they are very, very small piece of what affects the market.
Right.
And so what you're seeing is kind of normal and in some cases above normal returns during election years.
Yeah, and I think some of that data really makes sense if you strip it down and think about what that means. So, especially if you look at that international market, here in the United States, we're obviously much more in tune with our own elections than we are with elections in another country, say England or Germany or France, right? And the same is true for in reverse, right? Internationally, yes, there is definitely some interest in American elections, but they're not going to be as in tune to our elections as we are, of course. So they're going to be more focused on their own. So I think it makes a lot of sense that once the U.S. presidential elections are over, when we've inserted that certainty back into the market of, okay, now we know who's going to be in charge, who's going to be the president for the next 4 years, internationally, I think there's a big sigh of relief on, okay, regardless of who it is, we now know what these next 4 years of negotiations might look like. Whether that's good, bad, or in between, we're seeing that the data suggests that there's definitely a sigh of relief when the elections are over, that now we're back to some degree of a consistent policy strategy for a 4-year period.
Right. Market-like certainty. And I can almost hear the follow-up questions coming through the screen right now. So I'm sure people are out there saying, okay, great, market's positive, but isn't it true that when my party is in office, that's the good years, and when the other party is in office, that's probably the bad years. So maybe we can still time it based on who's going to win.
Yeah.
So what do we know anything about how the market behaves depending on who's in control?
Yeah, so there's some data. Obviously, when you start getting into very specifics on who's in charge, the number of years that we get shrinks. So the data becomes a little bit less reliable. That being said, it's about even. So whether we have a Republican president or a Democratic president, the numbers are almost even when you go back as far back as we can go to track that information with the markets and presidential elections. What I think is even more interesting is that, historically the best years have actually come from a mixed Congress. So when Congress is mixed and there's a more of a balance of power in Washington, D.C. versus a single party control on either side, we get a better, average return in there. And we've got some good slides that we'll share in the comments below, and we'll send those out to everybody so that you can see some really good graphics to kind of support what we're talking about. But there's no clear winner when it comes to elections, who wins and which party wins, and market returns. That's what the numbers really show us.
Yeah, and at the end of the day, we are looking at the numbers. I mean, if there was something there, we would tell our clients and the people listening. We have our only motivation is to create the best portfolio as possible. And if it said Democrats were better or Republicans were better, we would present that. But it's just not there. And again, I think that's, despite what politicians say daily, there's just too many factors that affect the market, and they're only one small piece of it. So I think one maybe other question, trying to guess what people are asking, would be, okay, it doesn't, Democrats, Republicans, maybe they have the same performance, but can we predict industries? Maybe some industries do better with certain, when Democrats are in control versus Republicans. And we even, again, data gets less reliable when we get more specific like this, but we have a lot of good anecdotal evidence that it also is pretty much it's a wash, and we can't predict. And I think a great example is from the recent, we've got Biden in office now, we had Trump before, and certainly I think this is not really debatable, different views on climate and energy policy, right?
Sure. Yeah.
Trump opened up drilling, very pro fossil fuels. Biden more if you can, pro clean energy or regulation,
Mm-hmm.
and actually through the Inflation Reduction Act, implemented the largest, basically climate regulation bill in history, 400 billion or something like that.
Yeah.
So I think if you were to go to someone and you could travel back in time and say, okay, this is what's going to happen. What do you think about us overweighting energy while Trump's in office, and underweighting clean energy, and then flipping when Biden's in office?
Yeah.
That sounds like a good strategy, huh?
Yeah. Sounds good.
Well, the numbers are strikingly the exact opposite of that. So, and again, I'll get to this other factors at play. But while Trump was in office, the S&P 500 energy industry, index, which measures the energy industry, or a large chunk of it, was down about 40%. Not what you would expect with a very pro fossil fuel administration. The clean energy S&P index was up almost 250% over that time frame.
Wow.
So pretty striking. I wouldn't think anybody would guess that. Well, since Biden's been in office, that same energy index has almost doubled, and the clean energy index is down almost half.
Wow.
So despite him implementing some of the most restrictive regulations, or at least as far as like dollars spent on controlling emissions and trying to prevent climate change. So, I thought that was very surprising and very helpful. And again, it just shows there are so many other factors out there. Obviously, we had a global pandemic. That was probably the biggest driver in fossil fuel demand and supply. And so even when we break it down by industry, it's just there's not a clear-cut winner based on who's in office.
Yeah. And I think that shows itself in a lot of ways, because one of the more common comments I think we get as advisors from clients is, yes, but this is why my preferred presidential party didn't do as well in the markets while they were in office, right? And that's a great point, actually, because the whole point is that it isn't solely reliant on who's in office. There are thousands of factors that go into market pricing every single minute of every single day. And the president of the United States is one small input there, but it is not everything, right? And I don't think that if you work in the oil and gas industry, I'm not sure that you think that maybe the current administration's energy policies are the most preferential for your business. However, the performance on those returns of your share price likely vastly better. So it just goes to, there's just so much more going on than just who's in office. And David Booth has a really good thing that he talks about, which is that you should really vote with your morals, vote with your values, and vote for the things that you care strongly about. But with your money, you should invest in the way that is the most academic and the most strategic, and invest in a diversified way. And don't try to time your investments with your voting preferences, because you just can end up missing out on some pretty substantial returns, and sometimes even ending an investment period where you're like, I can't explain why I didn't do as well as I thought I was going to do.
Right.
And the data just supports, right? Even in an election year, the markets are generally positive, and in the U.S. market, they're generally, I would say, a fair amount better. So it's not something to steer away from. It's just something to know that you're going to see a little bit more volatility likely, but you're also probably, over the long haul, if you stay invested through election years, going to get a better experience than sitting out those years.
Right. Yeah. And so, we, as everyone just heard, we are looking at the data. I mean, if anything ever changes that would make us recommend something different, we would do that. But the story is still the same, that we can't invest based on what's going to happen in election year. And I know that sometimes that makes people feel like a little bit helpless. What you can do, and what we always say, is you can work on your plan, right? We always talk about making sure your investments support what you're trying to do, and we can be prepared for whatever happens this year based on your individual circumstances. You can make sure your risk profile and what you're trying to accomplish fits you. And that is something that does make a big difference,
Yes.
regardless of what happens in
Mhm.
the election this year. So, yeah, I'm sure there'll be more questions, but we tried to hit some of the big ones we get. If there's any other questions out there, don't hesitate to shoot them over to us, and we'll do our best to
Yeah.
answer them.
Yeah.
So
And make sure you check the comment section as well, because we will have some additional links with some charts and some data so that you can kind of peruse through more if you like to get into the weeds with this stuff. I know I'm always interested in elections. I find the whole process pretty fascinating. So if you like details and you like looking through data, we'll have some supporting documents for you so that you can check that out and ask us any questions that you have.
yeah. Well, thanks for listening, and we'll see you on the next video.
Thanks.